Good evening, all. Ira Epstein of Linn Associates with your financial market wrap-up for Monday, the 22nd of November, 2021, about 6:30 p.m. Central Time. Interesting day. Today, President Biden, late as usual. Remember, he told us on Tuesday, within 4 days, he'll name everybody. Well, that's my math wasn't 4 days. He did today renominate Fed Chair Powell to be the chair, but in a good move, he made Miss Lael Brainerd. She is going to be your nomination now for your vice chair. That still leaves 3 open seats. I was hoping he would try to fill those seats. He wants to put his fingerprint on the Fed. He will. He gave the market continuity. The market liked it initially and then fell back. You have to understand, we are in a holiday mode as of now. As the market went up, and you'll see we got up to Bollinger Bands in some of the key areas and stock indices, they gave it up. The gold market, once those nominations came out, tumbled, and it tumbled hard. Was down $45 on the close. You're getting a bounce, still over the 1800 level. And my gold report that I created over the weekend, I think it's very much live in everything that I said. I realized that if you gave up the embedded reading on the daily chart in gold, you were going to tumble. But I also gave you the weekly charts, and that's where I think the game comes alive, is off the weekly charts. I think this was a big washout. On the energies, we are hearing that the president, I haven't seen it yet in writing, but it could be, that they're going to release oil from our strategic reserve. China's supposed to do it, Japan, and OPEC has said, well, if we all do that, they are going to go back to the drawing table and decide what they want to do with their production, because if the market's getting that oil, remember, they want to keep this market for them near $80 a barrel. They're your enemy, not your friend. And if you don't get that, shame on you. They want to take the money out of your pocket and put it into theirs. Of course, us going with all our greening and not doing it in a better method over the past decade, we're paying a price for that. But that's a different story. Bonds and notes got hit on the news. Now the market's saying, oh, now we've got the Fed back and they're going to suddenly raise interest rates. Okay. The market is making all these wild assumptions. We just decided to taper. The official announcement was, 2 weeks ago? And the market's already saying that, hey, they're going to get all this tapering done in 3 months, maybe by March, maybe it's 4, and they're going to start raising rates in June. That's what some analysts think. I don't know. Here's what I read. I read that in China, which has been a source of the inflation with the bottlenecks and the chain supply and inflation hitting them, is seeing inflation moderate sharply. Coal prices have come down dramatically, and that's their main source of energy. The shipping container prices have fallen rather sharply. Suddenly there's containers available and there's freight available, all at lower prices. Sounds like there's improvement in the supply chain. I'm also hearing from auto manufacturers, as I read the newspaper, that the supply of chips easing to a degree now. So you put that together, and I think it's pretty confusing. And try to say in November that in June's going to be your first rate hike. Well, that's what traders do. They're all over the board with these wild statements. But I think at the end of the day, the Fed is data dependent. And I realize we're all seeing inflation in the store. My wife just got back literally a half hour from the store telling me how high prices were. And I get it. But I also know they'll fall back as the supply chain takes care of all that. Give the market some time. As for COVID, and this is before we get into all this, it's real important because it is spreading like wildfire. I have said that Austria is in a lockdown, and it is. It's not for the whole population. I never said that. It's for those that have decided not to get vaccinated. They have a real problem. I have been telling you since June of last year that they're going to start making a distinction between those that don't want to get a vaccine down the road, that's a year ago, and those that have the vaccine. If you think that isn't going to go on and go on big in Germany, possibly the United States, you are very mistaken. In France, they give you a digital card. You take it. If you can get into a restaurant, it means you had your shots. If not, you're already discriminated against. Different in Australia. Austria rather, it's not Australia, Austria, is that they're going to start fining people at the beginning of the year $4,000 American if you don't get your COVID shot. And if you don't get a booster shot, it's going to be close to about half of that because of that. So they're really putting the pressure on because their economy can't afford it. Now, you're going to argue with that, and I know it, and I'm not taking sides. Please don't say I've taken sides. I report the news. That's it. But I have been saying there's going to be a distinction. People have a right not to get vaccinated, but they don't have a right to go out in the general public at that point and possibly infect those people. And that's what you're facing. Got it? You don't have to agree with me. It's the way it is. When we look at the S&P, you have not done any damage here. You're down 0.14% from the all-time high. And you hit, and that's on a closing basis. You made new highs on the whole move today. If you can't see that, let me just show you. Now you had a big reversal. Until that high's taken out, you don't begin the Santa Claus rally again. You have to first now see where the market wants to correct to. Take that out, the game's back on instantly, at least in my opinion. When I look at the swing line, we have a pattern of higher lows, higher highs. So I'm seeing 46.68 is probably the first number the market wants to test to see what's there. And it happens to coincide right with the 18-day average of closes, where I'd look for major support. Where did you go up to today? Take a look at that Bollinger Band. If you've taken my enhanced Bollinger Band course and you don't see what happened there, shame on you. Take the course again. You didn't learn anything. And that ties in with the market. I don't care if it's embedded or not. Here's how the market came in. The market, day one of embedding was here on Tuesday. Day two, day three, you're fully embedded. If you get up to that number, what I teach is you've got to take some money off the table. That's up there. And by the end of the day, if you have a reading under 79, you got to be out of the whole positions. You got out up there, you came out on the close, and you're now sidelined if you followed my course. In the NASDAQ, did we ever embed? So follow me. Both numbers are over 80. Next day, both over 80. That's Friday. You weren't embedded. So you went up, hit the number, and you just failed. Never were embedded. That was, if you were long, the area that the pros probably came out of all their longs. Now, you have a different world going on in the Dow. It's been in a bearish trend. You've had lower highs, lower lows. But when you hit the lower Bollinger Band, what do I tell you? That's where the pros are covering shorts. And in the Russell, which over the weekend I was reading report after report as to why this market should be so good and it'd be a revival in these. Maybe there will be. It could be headed to the lower Bollinger Band, though first it is not in a trend. In the VIX, I think the pros went short at the upper Bollinger Band. It got through that today, a little higher. It doesn't bother me. I think it'll come back down to the 18-day average of closes and fair soon. Very fair weather. This is very typical. Each time this market has gone up, it's gotten through that upper band with the spike. This could be the case again, and then it's quickly reverted back to these key averages until it changes its pattern. Why should I think it is? In the bond market, we have a pattern of lower highs, lower lows. So we had a rally into the 100-day average, green, and the 18, and we're fading away. We're still in a bear trend. We are oversold. If the market falls a lot more, I look for support at 159.7. That's where I'd look for the pros to take their money off the table. In the meantime, I think they're sellers into that 18-day average looking for that, but I don't think right now. Why? What do you think? Because you're oversold. Why would new money go into an oversold condition? In the dollar index, you have a fully embedded reading. So I keep telling you, when that occurs, you look for the breaks, and that's where the pros are buying, and they pop out against the upper Bollinger Band. I believe that's the case. Take the enhanced course. In the eurocurrency, you're riding the lower band down in a fully embedded reading. Still coming to the downside. Whenever it stops, it stops. The British pound, this was a bear market rally we had talked about, and all of a sudden the bottom fell out of it today. This is the holiday time in America. Traders put their money on the side. They go away for a couple of days, and then they come back with a vengeance into the market next week. They will be back. In Bitcoin, you do realize this is a market that was just at 69,355 a couple of weeks ago, not even a week and a half. It is now pushing here at 55,600. It's gone from the upper band to the lower band. It's not embedded. It's overdone. This is where the pro has probably come out of any shorts that he might have had. The differential between January Brent and WTI keeps widening because of just what I said. We're talking of releasing reserves. Now, the president is saying, could happen tomorrow, that he's going to release a fuel from our strategic reserve. As China wants to do the same in Japan. OPEC's our enemy. I went through that whole thing about that. So the differential, well, OPEC may stop that much production. That goes up. We're going to get more oil. That can come down. And that's the widening of this. You see this right here. But whenever you hit a lower Bollinger Band and you're oversold, what do I teach? That is where the pros probably are coming out. I think they came out here. I don't think they caught that second part of the play. In the U.S., if you embed, it's one thing. You're oversold. I think the U.S. traders came out around there. Heating oil, I think the market is oversold and it keeps coming down there. I think between this lower band and the 100-day average is where the support is. That's not a buy signal. That's where the support is. And in that gas, I couldn't begin to tell you what happened in that market today. Here's what I can tell you. You had an outside day up, and if you take out the low of an outside day up, and by the way, the low that day was 493.30 on Friday, then I'm looking for the closest of a key moving average or a lower Bollinger Band. It's exactly what you did today and getting a little bounce from it tonight. It's already hit its downside targets is my point. I did as I told you with a special report on gold. Now, what I did throw out of it this time was the seasonality and price counts. Instead, I put in your gold ETF. I put in GDX, the miners ETF. I included in this report the futures, real in-depth weekly analysis, and then I went to the daily. I gave a what-if scenario. If the daily charts failed, which I didn't know if they would or wouldn't as of the weekend, then I look for the weekly chart to take over. You're coming down to those numbers right now. How do you get to see the report? It's simple. Just go to our website, under the word research at the top, click on it, and away you go. You'll see it there. Just click on research. It's all there for you. I'm Ira Epstein. You have a good day. See you in the morning.